Joining us now to take a look at what's kicking up in the markets is Jacobus Brink from the Schmidt Family Office. Jacobus, always a pleasure and a good afternoon to you.
Good afternoon to you as well. Always a pleasure to chat.
All right, Jacobus, maybe we can start off by just reflecting on what we're seeing in our screens today. Markets just seem to be jittery, not only here at home, but even globally here. And I guess we can owe that to geopolitics. But I think the interest rate picture is also looking a little bit more uncertain than what we'd like.
Yeah, no, definitely. There's quite a few things going on, and as you mentioned, geopolitics being one of them. We'll chat about that just now. But I think the big thing today is definitely interest rates. You know, we've been of the opinion, sort of into the end of last year and starting off this year, that the market was extremely optimistic in pricing in rate cuts from the Fed, and we've seen over the past number of days, you know, there was quite a few of the Fed speakers that came out that was trying to sort of push back a little bit, you know, on market expectations. You know, I think the big thing currently is, you know, also especially that we saw yesterday out of Davos, some of the European Central Bank members also pushing back. So I think in general, it's just sort of an interest rate story at this stage, you know, and definitely the market was extremely optimistic in pricing in those rate cuts into next year. We obviously saw some inflation figures out of the US last year actually starting to tick up again, which would be a big concern going forward. So, yeah, and I think it's an interest rate story, and this week's going to be interesting. You know, we're also seeing some inflation data out of the VOE tomorrow, as well as out of the EU. So, yeah, I think it's going to be sort of set the trend for the next couple of weeks going forward.
Let's touch on the geopolitical issue, because what we are actually seeing there is some form of escalation, you know, Jacobus. I think when we speak about just market participants, on the back of COVID, it literally has been shock after shock. And I think what we're seeing in the Middle East now is another shock, one that has the kinds of consequences that we're not quite clear on at this point.
Yeah, no, definitely. You know, I think the big thing currently is, you know, you saw some Houthi attacks on the ships in the Red Sea. You know, that's been sort of escalating continuously over the last number of weeks, and I think the latest sort of attack we see is just sort of setting the trend there as well. You know, the big question on everyone's minds from here on out is, you know, is this going to be a protracted situation? Or is it going to escalate into something worse? You know, we don't want to see or mention the word war anywhere in conversation nowadays, but I mean, it's clearly gone to a next level. And, you know, Brent crude is obviously holding up fairly steadily at this stage, but it does seem that, you know, those tensions are definitely moving in the wrong direction. And that once again, you know, could you know, snowball into the effect of, you know, we're going to see higher oil prices. We've already seen shipping rates skyrocketing last week because of these tensions in the Red Sea, and that will obviously once again feed into inflationary pressures, you know. And I think that's the big risk. Other than the fact that there's obviously a geopolitical risk, I think the big risk also is it's going to start to feed through into inflation, and that's obviously going to dampen the mood in a very big way for the stock market that's pricing in quite a benign sort of inflation outlook for the year to come.
My big concern at this point, Jacobus, is the fact that there is no more room for high inflation in many of the markets that we look at. South Africa, I think Europe and the UK are very similar here. We don't have any more room to increase interest rates. Growth is plummeting. I think only the United States looking strong with some form of growth there that they can afford to see pull back. And with Middle East tensions mounting there, we could find ourselves in a recession that is deeper than what we anticipated.
Yeah, no, I agree 100%. You know, I think I mentioned it once or twice last year, the dreaded stagflationary term, but, you know, it seems that there's a possibility that we might be actually steering off onto it, you know. There is, to some extent, as you mentioned, also divergent sort of growth pictures. But once again, you know, even if you look at the US growth, which came in very strong in the third quarter of 2023, we're still waiting on the numbers for the fourth quarter. A lot of that was actually driven by fiscal spending. You know, we did see some of the, you know, the consumer was still strong as well, but, you know, at some stage those high interest rates are going to start to kick in, and we're also seeing quite a big divergence between the global economies. You know, we've seen the inflation numbers, as I mentioned last week, in the US starting to pick back up again. The ECB is clearly concerned about inflation going forward. We saw some of the recent numbers also ticking up and staying sticky. I think the one that might be a little bit on the other side of the fence is the UK, because for the first time in a while we've actually seen their earnings inflation is coming down a little bit. So that could possibly make a little bit more room for the BOE to start cutting rates earlier than the other two. But once again, you are now starting to move into a environment where we could possibly see, a repeat of what we saw in the 1970s, where initially inflation started dropping off, financial conditions started to ease way too much, way too quickly, which was what we saw in November, December last year, and then all of a sudden, inflation starts rearing its ugly head again. So I think that's the big issue for markets into 2024.
I was hoping for a more optimistic conversation around the state of affairs. Let's look now to China. We're expecting Q4 GDP out this week, but also Country Garden has come out to say that they expect the property market to remain weak there. And I'm just wondering what to make of China's picture. Our commodities have been, really battered by the realities in China, and we need, China to do well so we can see some upside in that part of our economy.
Obviously, Country Garden, it's China's largest private property developer. So, I think we should sort of take what they say with a little bit of earnest. It obviously defaulted on their bonds. I think it was worth about $11 billion worth of bonds in October last year. And, with them coming out with a guidance that is also less rosy, it doesn't paint a very good picture for China. And as you mentioned, if we're going into a sort of a recessionary, stagflationary environment, obviously the demand for any commodities are going to also be impacted quite severely. And we still haven't really started seeing the Chinese consumer turning a little bit more optimistic, so there's still a lot of pessimism in the Chinese economy as a whole. And we need China to start driving, growth globally as well. We need to start see them exports and imports and everything start to pick up again. And we haven't really seen that as yet, and that also remains a bit of a concern. However, there's a lot of bad news priced into China. So I think any sort of flicker of optimism might see us rebound a little bit there, but at this stage, it looks fairly bleak. And to that point, we've also seen some other companies in the US of late report earnings, and some of the guidances that they're also giving there is also fairly negative for the year. So I think the market where it's currently priced, it really is priced perfection, soft landing, and the data we're seeing now is not really pointing in that direction.
I must also ask you, Jacobus, before I let you go, we move on to your stock pick rather. Then we bring it home to South Africa. Our equities have also taken a beat in 2023. On the upside, I guess we could say that they're more affordable than they ever have been. But of course, we are also battling to see some an environment that may support our equities, specifically looking at SA Inc. And I'm wondering what that means for the JSE South African equities and instruments this year.
Yeah, no, I think, if you just take it sort of on a relative value sort of basis, South Africa has been cheap for a number of years. And, what's going to be the impetus that's going to turn that around? We are starting to see a little bit of a more positive outlook when it comes to, electricity generation. I think, we're obviously coming off a very low base there, seeing that the first, 30 days of 2023, we had load shedding. And at least this year, we've had a few days that we had minimal sort of load shedding. But I think it's moving in the right direction. The situation around our ports and sort of general, railway infrastructure and all of that, there seems to be, but once again, seems to be the right noises being made of it. But once again, it's going to come down to the implementation, and as I mentioned on a few previous shows, I think with the private sector getting involved, we could possibly see, a quicker turnaround there than the market's currently pricing. But I mean, it's still, if you look at it, investors are shunning South Africa in a big way. And we obviously need to start seeing some of that foreign direct investment coming back into the country to really sort of bolster growth as well. But the other problem is also, our growth. The growth rate wasn't bad. The latest numbers we saw out of Q3, but still, there's a lot of pressure in the South African economy as well. And with interest rates where there are, a possible turnaround in inflation, it's definitely not going to be a good story.
With that said, Jacobus, keen to get your stock pick today. Which counter are you going with?
Today's counter is a little bit of, I suppose, of a contrarian pick, but it's Sasol. It's trading extremely cheap at the moment, very high dividend yield. A lot of it has to do with the fact that I'd like to hedge my oil bets. I'm a little bit more concerned about the situation in the Middle East, that we might actually see it escalate into a full-blown war, especially with regards to what's been going on over the weekend and the last few days. I know Sasol definitely has their own idiosyncratic issues that they're dealing with. Investors are not positive with stock at the moment, but I still think we're currently trading. If you're taking a longer term point of view on it, I think it's not a bad buy.
Well, always a pleasure having you with us, Jacobus. So thank you so much for your time today. That was Jacobus Brink from the Schmidt Family Office with your midday markets update.